what we have in front of us is 3 different types of price delivery that are all part of a ideal price delivery that we look for when we come to our chart. So we just wanted to cover each one. So first of all, just to cover each one, is you have that range, and then you have that initiation out of the range. You have that initiation creating cause as it moves away, right? And then you have that mitigation and that continuation, right, or reaction, initiating lower prices. So this is what we're going to dive into today. So obviously we know these, we know what these looks like. We've all had time and experience to observe these in the market. So what we wanted to do was just kind of highlight what we're seeing. This is where our confidence is built from, being able to recognize these types of price delivery. So first of all, I'll go through the first one. Of course, we have contained price. So that's what these 2 red highlights are showing. We have that run of higher prices, right? So that run out of the range. We always assume that this, exactly, right? Liquidity grab, mitigate something and reacts. That reaction, right, is that intention of lower prices that we're seeing being delivered. And this phase, right, so we go from that range and that initiation out of the range. And here we see that that initiation, that aggression is towards the downside. So this is where we can understand that BFIs have been stacking inside this range, and the orders that they've been stacking are short positions. And that is being represented by the market initiating out the bottom of the range, which is showing us that price is bearish. So that's what we see happen here. So we understand contained price, stacking in the range, and initiation out of the range. And that's where we move into this second part, the initiation.
Cool. So part 2 of this price delivery, we've got initiations. So every initiation is going to look different in the market, but essentially it's just a strong move in one direction. And it'll be very, very obvious, obviously, after a sideways range. But after we've had the initiation, or even during the initiation, now price is going to be creating liquidity in order to push price back up to mitigate out of this range that we've had here. So that's actually the point of this, to create lower prices from the range, and obviously to create that price range now between that high and that low, to create liquidity within the range in order to take that liquidity and mitigate out of positions from the range. And then obviously this is when we move on to part 3, which will be that continuation of price after that mitigation.
Exactly. So as Burton says, we're building cause, and now we see price start to head back up. And our understanding here is that price intends to mitigate out of the range, right, that the aggression started, right? This is our footprint that we look for. So as price starts to move up now, we see how this price delivery on the way up, right, we're seeing is that same intention of price delivery, right? And here we see cause being built. Here we see supportive liquidity to support those higher prices for that mitigation. Right? So we see how, we're constantly building cause, right, in a range to initiate out of a range, and this, ideal price delivery and us seeing this this point of mitigation is what we want to look for. So prices heading up is, as we see in this price delivery, is quite corrective. Notice how price is more sideways, right, as we're delivering up. Here we see very aggressive. Here we see more sideways delivery. Again, we understand that to be building liquidity, building cause to support lower prices, right? So as price comes up back into this range, what we expect to see is BFIs mitigating out of any losses that were created here, right? And using that volume that they hold, right, to initiate further sell orders, right? And notice that in this price delivery, what we're seeing here is them clear the entire range of its liquidity. So this would be, exactly, right? And this is the same process we're always looking for on the market, right? In the market. This is what we want to train our eyes to see, right? So what do we have? We have range, We have initiation out of the range. Notice that this initiation creates an OB price delivery, right? Where we see that swing up, right? Reaction, right? Previous range, and we see intention for lower prices. As price starts to head back up, right? We understand that in this moves down, we created cause to support higher prices. This is where we see the market reacting from, creating cause, right? Supporting higher prices for that mitigation. We see a mitigation out of BFI losses, and them now initiating that next phase of the move, which is that continuation, right? So here we're always expecting to see a reaction, right? Because we have the ideal price delivery. What we want to see is that we're flowing with the higher time frame, because this will be a higher time frame price delivery that intends to move price and continue price lower. And here we have our full ideal price delivery. This is what we want to look for.
So you've got to remember as well that in the initiation phase, let me just clear this. In the initiation phase, this part here, this can look any sort of way. The most important thing is that we've had a range, we've initiated lower prices that's caused a break of structure, meaning that this is a strong high, essentially a lower high. But anywhere within this initiation phase here, it can look so different, and that's the variations of price delivery. Essentially, it could look like this, and then come all the way back up and mitigate, continue. It could also look like a range, higher prices, straight drop, and then come back up, drop again, and then come back up and continue. But the important part here is that it's created a strong high. So we know that this is essentially a strong level of supply in the market, or an OB, buy to sell delivery, which we out of obviously a range, which is a price delivery. But this is what's important, this part here. What it's creating in between this high and this low, being the price range, doesn't really matter too much, because all this liquidity now, whether it's equal highs that they've created here, for example, just before the mitigation, or there's just a high down here, and then they've pushed price up, it doesn't really matter. All this liquidity is going to get taken. What's important in this price delivery is what's happened up here. So, and obviously in this move up, what's being created, because essentially this down here is just a weak low now. Between this high and this low, it's just a weak low. And yeah, so that is literally all that from there, though.
Yeah. One thing I was going to say is, so, it's not about so much, having all of these theories and trying to determine the direction of price all the time, right? Are we going to see lower prices, or are we going to see higher prices? Obviously, that's always a question. We want to intentionally be on the right side of the market. And the way we do that is by identifying what you're seeing here, right? This is all we need, right? We could take this price delivery over and over and over again, right? Some we will lose, some will win. Some will be break even, or however you're managing your trade. But the point is here, if we're always looking for this type of price delivery, right, what comes after that then is making sure that this price delivery is in direction of a higher time frame, right? Or this reaction that we're seeing here from this mitigation is happening on a higher time frame, because then this is giving us our cause to see lower prices and for lower prices to sustain, right? So when we see that pullback into the high of the range, we can then assume, right, at this stage, as price starts to approach this low, that this now becomes a weak low, right? This is following that higher time frame direction. This low is just being created for liquidity to run that, into the higher range, and the liquidity that's been created here, right? These reaction points are all, essentially going to get wiped out, right? So we may see them reactions off of these, but the intention of price after this higher time frame mitigation is to take this swing low, and that's how we're gauging our direction, right? There's not much thought you need to put into it, other than, well, there is, but the point is here, it all starts with first identifying this ideal price delivery, because then we can always allow ourselves to be on the same page as BFIs, because we're following their how they deliver price essentially and their footprints. So now we're going to get into, if Bern doesn't have anything else to add, Bern?
No, that's it. Jump into some charts.
So now we're going to jump into the charts. I think we're going to go through higher time frame first.
Yeah.
Sweet.
So cool. So someone asked us to go on to higher time frame, and obviously this is to understand how to build narratives, which is exactly what we do when we're looking at price delivery as well. So essentially we're always just looking at unmitigated ranges. These essentially become our, and obviously momentum shifts at higher time frame points of interest. So what we're about to show you now is what we literally do on every single time frame. But the only difference is this will have reacted off something previous on a higher time frame that we can't see. So obviously that's where we use our time frames now to flick through and see what this reacted from. Is this an unmitigated range? Cool. Has this caused higher prices, momentum shifts, and so on and so on. But essentially what we're looking at when we're looking at higher time frames is just unmitigated ranges. So any sort of sideways delivery followed by initiation that hasn't been mitigated from yet. So obviously this is a sideways range here, initiate lower prices, we go into another sideways range here, and then initiate higher prices. So this would have reacted off a price delivery like this on a higher time frame. This one here. Just go back, just clear this. Cool. So as we see here, we've got again sideways range followed by initiation of higher prices. Notice we react off this unmitigated range left. So this is literally what we're doing. So we're seeing that this is reacted from a range to the left. We've initiated higher prices. So obviously we're here on an M1 looking at momentum shift for higher prices. Then we're looking at, cool, where could the market potentially go to? Well, this is an unmitigated range, and that's exactly where price goes to. We get that reaction, obviously comes back down straight into that unmitigated range here. So just imagine a range, initiation, mitigation, continuation. But from the video that I've done yesterday, all of you should see as well that we're always reacting off a range. So obviously it just depends whether supply overpowers demand or demand overpowers supply, and that's essentially just what we see with higher and lower prices. Just another way to describe higher and lower prices. But essentially here, any of these lows in here we see get taken out, and that's liquidity being built in order to mitigate out of this delivery here and cause higher prices. And also notice that this then creates more liquidity under here for something in the future. And obviously we see higher prices, then we're literally always reacting off something. So we'll see here, we've got this pause in price action here, and then that's what we've reacted off here. So it's just training your eyes to see these as well on a higher time frame where price moves down and we get like a little pause and then we continue lower. So it's again that just that inside price delivery, which is range, initiation, we come back up and mitigate and continue. And obviously from what we said previous, anything, it can look literally like anything on the way down and obviously still come back up and mitigate out of that range. Sorry, I was drawing, but mitigate out of that range and then continue. And then literally and it's just continuous. It's continuous.
Same thing over and over. I just wanted to quickly mention about when we used to ask ourselves, right, what is a real swing high and what is a real swing low, right? And a lot of the times when you're going through your time frames, you can see these, right? Because if we was to look at this price delivery right now, there's one thing that jumps out to me, and that is this reaction that happens off of this mitigation, right? Do you see what it causes? Right? It causes price to swing from this level, right, down to this level, right? What did both of these highs and lows have in common? Look at them. Look at the reaction we have after the mitigation, right? So can you see how price is contained between this high and this low, right? As price is moving from this low back into this high, can you see that all of this that was created on the way down, right, are becoming reaction points, right? Where we see price react, no follow through, right? React, no follow through, react, right? Follow through at least to take out that lower time frame swing low, right, into a higher time frame unmitigated range, right? So we're always seeing this, these three phases of this price delivery, right? Just by seeing and understanding and training your eyes to see this price delivery, you start to see things like this, because now we have, as I said, sorry, Burton, let's get that back and delete mine, my drawings. So just by observation and understanding this price delivery, we can see how strong highs and strong lows are made. And with that identification, we can see how we have now a swing high and swing low. And not only do we have that information, if you go to a higher time frame, this would be quite obvious, right? But look what price is doing within that range, right? Look how price is reacted, as Burton shown, right, to every single range that has been left, right, behind in this whole price delivery. This is what we're training ourselves to see, right? Everything is reacting from a range. So we know that what we need to identify is, what we need to be able to recognize is a range being delivered. And when is a range being delivered, right? Pretty much all the time, because as Burton said, we have that initial, ooh, that was a wrong thing. Sorry, guys. As Burton said, we have that initial range. Pen tool. We have that initial range, right? And then price moves out of that range and creates a new price range, right? And can you see how price is now contained on a higher time frame between these 2 points of the market? And what can we see price doing, right? Reacting on things that are left, right? Left, 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 right? So there's no when we're talking about higher time frames, we understand we're still looking for that same identification, right? We're on an hour right now. Let's say the hour is not really clear to you. You don't see this range here that we have here, and this initiation and this pullback into the, you know, the higher premium of this range. Let's say you don't see that. This is where we're using our time frames, right? We're using our time frames to gauge and recognize price delivery, right? So it's not about one time frame is more important than other. We're using our time frames to gauge and to train our eyes to see this ideal price delivery that we're on, because quite clearly and quite simply on a higher time frame, right, this is going to be that move, give a pen tool again, this is going to be that move down, right, that swing back up, right, and we see that's contained price and move away, right? That's going to look like a candle down, a candle up, right, so that holds, right, a candle down, right, and then we're seeing this type of price delivery into the high, right, of where we see this reaction, right? So, you know, we understand there's time frames are important, of course. Higher time frames are important, of course. Lower time frame is just as important, of course. But what we're recognizing here and what we're training ourselves to see is the ideal price delivery. This is where you want to put your focus, because from this recognition, you're able to then build all of your points of interest. Essentially all of your ranges. You're able to understand all of your ranges within this price delivery. And then you understand, right, when price initiates at a point, a higher time frame point of interest, and starts to create, right, a momentum shift and a move in the opposite direction, we understand that that intention is rather to create higher prices on a higher time frame. So we'd assume that this is, you know, a higher time frame mitigation, right? Or it's to create, this is a reaction point on a higher time frame to create a move back into premium, right, to continue that selling bearish narrative that we're seeing, right?
I was just going to say as well that this is what's creating narrative for us as well. So if we're able to just understand that we've come from a sideways range, we've initiated lower prices, all we're doing now when price is coming straight back up, all we're doing now is when price comes back up into this point, essentially we're just dropping to a lower time frame and watching what's happening. Are we seeing momentum shifts? That's confirming lower prices to us. Even if it's just to mitigate out of a range here, to us this might be a 1 to 20, for example. So this is literally what we're doing. This is how we're building narrative. We're not coming to the chart and going, right, bearish, we're only looking for sells. It's not about that. It's about how can we play every single range, because we're always moving from a range, from one range to the other, which means we have direction for each range. And essentially that's literally what we just look at. Unmitigated ranges. When we get there, cool, now we're looking at price delivery, range, initiation, mitigation. If this is a true momentum shift at a true bullish price delivery at a bullish price delivery on a higher time frame, then we're going to see higher prices. So then this high becomes weak and it becomes a target for liquidity. Again, this is obviously what we're targeting, the structure high, but this is what we're trying to play. If we're trying to play shorts, if we're trying to play shorts from up here, for example, we know that this is a potential area that we might want to turn around and look for buys again, or look for a hedge, or take off our position here, because we know that we're always between ranges. And obviously, if we're going to see higher prices here, if we believe that we're going to see higher prices here, then this is a point to get out. Any of these points obviously then just become liquidity. But yeah, that's literally in terms of in terms of like building narrative. That's literally what we're doing when it comes to the charts. We're bullish forever or we're bearish forever. It's just we're looking at ranges. We're understanding what's happening when we get to that point on the lower time frame, and then we're just trading with that momentum, looking for exactly the same thing. If we get to, we're looking for this on a lower time frame at this point here, because that's initiate. It's literally range, initiate lower prices, mitigate, and at that mitigation on the lower time frame, they've initiated lower prices again. That's all the confirmation that we need in order to take trades, because now we're always following the intention and the momentum.
Oh, and what we're expecting, right? Our only expectation, and this you've heard me say this before in the videos. When I say this, please don't take it as literal, but I'm just trying to show you the only level of expectation we have, and that is for a reaction. Right, I know if there's BFI stacking and there's been intention for lower prices, right, when price gets back to that price level, right, BFIs are going to look to protect their high for one and mitigate out of their losses for two, right? So all I expect to see is a reaction. That's what I want to play, right? I'm just playing a reaction. I'm not trying to guess direction. I'm not trying to guess higher time through. Of course, if it makes sense, which I'm about to quickly go over in a minute, of course, then you can play that narrative. But essentially, you have everything you need, right, in the charts. It's all about just saying to yourself that you're confident and you understand price delivery, right? You can recognize what we're seeing, and you can do similar to us right now, right? Where we're drawing up our charts, right? This is the process of where we want to get into. This is what we want to recognize, because then on a higher time frame, right, when you're getting into these trades and you don't know whether to hold or whether to close, right, this is what we say to ourselves. Well, where did I get in on a higher time frame, right? If I got into I'm just going to delete your drawings quickly, but if I've got into a trade that's here, for instance, right, and we've seen this type of price delivery, we've seen this low get broken with intention, and we see this sideways price delivery, right, as we move in, right, and move away. If I'm asking myself, right, I've got into this trade, right, can I hold it, right? And the first thing I'm thinking is, yes, I can, because look, we're at the edge of a range. Where do I want to hold this trade to? Where makes the most sense, right? At least first, it's the bottom of the range, right? Because anything beyond here, if my stop is below here, what I'm saying now is that this mitigation is caused to create lower prices. That means lower than this low, right? Of course, we see lower prices here, but we understand that this is inside the range, right? This isn't lower prices from that's being created within this range. Right, so this is what we see. We see price moves to the bottom of this range. I'm looking to take target. Why am I looking to take target here? Right, look where we are. This is an ideal place to mitigate out of a range, right? So can I take my hedge position? Of course. Or can I just take profit? Of course. But if you know how to read price action, when you're in that trade, you can start to ask yourself that question: where have I got in within structure, right? Within the ideal price delivery. And if we've got in pretty much at the top of a range, right, then I'm looking to hold past the lows that we see, right? If I'm asking myself, let's say I've got in here, for instance, right, we've had this big sell price delivery and I've got in here, right, where am I looking to hold my trade to? Obviously I'm going to look to hold it again back into the bottom of the range that's been created, right, with possibly intentions of seeing lower prices. But each time, based on where I've gotten in the market, where I've gotten in based on structure, I'm able to understand whether I'm in a trade that I want to hold long term or a trade that I don't want to hold long term, right? When we're seeing this type of price delivery that we've had over these past couple of weeks, and we've seen that we've been inside this range, right? Are you taking a trade here and trying to hold past here, right? And then seeing your profits go to waste? Well, there's no need to do that because you're at the bottom of the range. This is an ideal place to take profit because of what we can see based on what we understand about price delivery. And this is why we don't let our profits shit away. We pay ourselves, right? You don't need to sit here and catch a 100 trade, right? It's about paying yourself as a trader, right? First of all, you're going to pay yourself 1,000, then 10,000, then 20,000, 100,000, right? That can all be done off a 20%, a 20% move. You don't need to 100, pip move to make 100 grand, right? Your account balance is going to grow through those 20 and 30 and 15s and 10s and 25s and 35s, right? Your account's going to grow massively just from those numbers alone. So yeah, make sure you're just always asking yourself these, very important things in price delivery, because it's always going to keep you on the right side, right? And if you're always following those intentions, right, of seeing that type of, right, OB type price delivery, swing above the high, right, out of a range, break the low, right? Here's our BOS. We have cause being built, higher time frame mitigation that creates that momentum shift, right? Price pulls back up, right? We create that cause below and we see lower prices, right? Where are we looking to get into our trade? Well, obviously at the top. Someone could have got in here, someone could have got in here, right? Someone could have got in here, right? All I care about is that I'm following the right intentions. Right? I don't care whether I took a loss here, right? Am I seeing? Yes, I'm seeing the right thing. Yes, what I think is correct, right? How I read price is correct. This is the type of price delivery we're seeing in the market. This is where I want to build my confidence, not from the trade itself, right? Of course, when you do hit that trade and when you do get into trade like this, make sure you're taking the most lessons you can, because these are the trades you want to hit, right? The ones that go on to win big. And again, how do we get into these trades? With the same idea of range, initiation, cause being built, mitigation, and continuation. And here we have a simple, right, bearish trend that we're witnessing. So yeah, higher time frame. Don't let it confuse you guys. We're still looking for the same thing. Yeah, just train your eyes.
Cool. So now we're going to take you from a higher time frame to lower time frame. So this is literally what we do. We're just looking at higher time frame ranges between two higher time frame ranges, and obviously here we've refined to see that this is a range, and again this will be a range on lower time frame as well. But obviously this is a sideways range inside a range, so obviously you can have ranges inside ranges when they're on the higher time frame as well, and obviously lower time frame inside a larger range.
And this is go on, sorry.
I was just going to say I forgot what I was going to say.
Oh, I was just going to quickly say that what we're seeing here when we talk about these ranges within ranges, because we've mentioned it a few times, right? But this is essentially what you've heard other smart money people talking about when they talk about refining their OBs, right? All we're doing is taking this higher time frame range, right? Sorry, that's a bad drawing. This higher time frame range that we're seeing, right? And let's say we see something like this, right? So when we're seeing price initiate out this range, we can see that initiation has happened from here, right? So when we're drilling down and we're trying to find that, ideal OB for price to come back in and play, what we're doing essentially is going down and we're refining on a lower time frame what this higher time frame looks like. And it's not to overcomplicate it, right? All we need to understand is, where did price initiate it from? Initiate it from a high, right? Where's likely price going to react from? It's going to, again, react from somewhere, again, near the high, right? So this is all we have. This is our full range, right? From low to high. And then this is our range within that range. And this is this here. And then this range here is within that range. Right, we're on a 1 hour.
To make it easier, I literally just say these are sideways ranges and this is a price range, just to make it a little bit easier to understand as well.
Yeah, and it's good that Burton started saying that, because I even use that myself now, because it's just the understanding that when we're seeing this type of price delivery, right, and we see this range being created or this range being created, we know the intention of it, right? The intention of this range to create lower prices. Now we know that they're going to want to mitigate out of that, right? And that mitigation is going to cause lower prices. So we're already directing the market before it's even got there. But now what we're doing is waiting for that price delivery to present itself.
And basically, when we're looking at higher time frame, so let's say this is the higher time frame picture here. When we're going down to the lower time frame, we're literally just looking in this part here to watch a momentum shift to confirm lower prices, because what they're doing there is they're changing from bullish volume to bearish volume, and that's obviously where we see the also from suppliers overpowering demand. These are the same things, they're the same understandings, but what we're doing is we're seeing BFIs initiating lower prices at a point where we would expect to see lower prices. So then now literally just going to go down to the time frame, lower time frame as well, and literally just show you that what we're showing you in the higher time frame is exactly the same as the lower time frame. All we're doing is just following the higher time frame intention. So we're just seeing, again, just range, initiation of higher prices. When we come back into this point, we're looking at 1 minute or 15 seconds. We're waiting to see a momentum shift, either one of these two here, a momentum shift. And then either this is going to continue higher prices after this momentum shift, and then we'll start to see BFIs initiating more positions, or we're going to see BFIs initiating more positions down here. And these obviously then just become our opportunities to get involved. So that's how you see us hitting these 10, 20, 30 Rs, because all we're doing is just following this higher time frame, range, initiation, mitigation, continuation, but we're jumping in on the minute chart. And because price is fractal, we're seeing exactly the same price delivery on the minute. And that's how we're able to obviously confirm higher prices and obviously get involved in opportunities on the way up. But cool, unless you wanted to add anything more, let's jump into the lower time frame.
Right, so now we're in a lower time frame. So yeah, as you've already seen, we have these higher time frame points of interest that we've roughly drawn on, right? Just to show you guys the kind of, as you saw, the high, the low, and then those kind of refined areas. Again, based on the 1 hour, on what we could recognize and what we can expect. Yeah, so now we're just going to kind of roughly just go over all of this price delivery and show you how what we're looking for in a higher time frame is the same thing we're looking for in a lower time frame. We're not going to zoom into this and go over it in detail. We're just going to kind of skim over. So of course, you know, do your own due diligence and, you know, get some refinement and actually dive into all of these little bits of price delivery. But yeah, just to build your expectation. So yeah, Burton's going to start at the bottom where we get our initial reaction out of our range.
So essentially this is that range being created, that sideways delivery, followed by that initiation that's never mitigated. So now this becomes an unmitigated range, which obviously we see on the higher time frame as well. Becomes an unmitigated range because we never got that A, B, C mitigation continuation. But instead, obviously, what's happened now is that becomes an unmitigated range, which is obviously cause for future lower prices and a mitigation in the future. But now we're just literally watching as liquidity is being created in the opposite direction. And Chucks was going to cover this bit as well, but watch as liquidity is created in the opposite direction of the position. And watch as liquidity is created in the direction after that mitigation on a higher time frame.
And it's simple thinking, right? When we see contained price action between a high and a low, right? What we understand, right? This is a contained price action, right? Now, one thing that is definitely true, and the reasons why every single high and every single low will always get taken is because above here is liquidity and below here is liquidity, right? Liquidity residing outside of the range. And this is what price is going to want to target, right? So when we see contained price action, we are seeing liquidity built on both sides, right? So as Burton just drew, we're seeing it on both sides. So we see this being created here, right, to support higher prices, exactly. And we see this being created within this range, right? So now we have liquidity on both sides. What do we see, right? Liquidity is cleared, we mitigate, and price continues. Right? What do we see here? Like when we talk about price delivery, we're delivering like this, right? Or we're delivering like this, right? What do we understand that each are creating? Yes, both are made for liquidity, but we can know that by this type of price delivery that this is happening, right, across a higher time frame. Now we know this area becomes quite significant because this essentially holds more weight than if it looked like if it was this big, right? So duration of time is giving us our level of what's the word, cause, right, to effort, and we're seeing that move away, right? Once again, as we see price pull back, right, to where Burton's drawing this box, right, we're seeing that representation of the same thing, higher time frame, right? Look how this is happening over time, right? Then what do we see price do afterwards? It leaves the range. How do we leave the range? Can you see that intentions from lower prices are following through at these higher prices looking left, right? What can we understand is probably happening here, right? We have price action on the left supporting, right, these reactions to create liquidity to continue price moving higher. So yeah, obviously we move into this higher point of the market. So we get that range again, right? We get that move out the range, right? And we create that high. And what do we know about what's significant about this? We know that this is now in higher prices. When we know our range high starts from here, right? And we're just before here. What do we understand? This is where we're going to start to see reactions that are going to hold more weight to move to the downside, right? Before this point, right, there is not much to support cause or intentions for lower prices. And that's why when we're looking at these types of mitigations on a lower time frame, what we're seeing and this price delivery that we're seeing that's intended for higher prices is intending to build something for the future, right? And this is what we're going to dive into now. So remember what we're seeing here. We're seeing these ranges, these mitigations, and these continuations consistently. We're also identifying how long these ranges are, right? Do we have prolonged sideways delivery, right? Or is price initiating higher time frame, higher prices, right? And this is what we want to try and recognize in price delivery all the time, right? So here we're seeing that cause being built and that cause run for higher prices. Notice that down here we get nice strong price, right? But in here, notice that price becomes very sideways, right? What can we see happening? Liquidity being created, right? This gets run. This gets run, right? Notice that we get that reaction, that pull back into that reaction, right? And that move down into, right, this range that's been created, right? Then we see that move away. And notice, we're always asking ourselves, why is this happening, right? Why is price not moving into a bottom of a range, right? We can understand, as Burton's drawing on, we're watching price hold and build liquidity, right? Because think about this, if price was to move down and mitigate here and create higher prices, what can we see, right? We see intentions following through. But when price doesn't do this and it moves away, what do we know that's left behind, right? Unmitigated OB. So now we understand that price will intend to at least move into this because we've not seen a reaction. And what do we see? That reaction, right? Pull back into a range and continuation. So we can see now that this price, right, this cause that was left behind, we can see how future price intended to use this liquidity left, right? And what we see here is essentially a mitigation out of their losses, right? Moving that liquidity, right? And adding that liquidity, bam, that's when we get that run of that low, right? Look at the force that's used, right, to run these lows over here, right? And then Burton's going to continue going from this on the right side, from the momentum shift. But what I'm just trying to show you here is when we're watching price move away, right, this is what we understand. Price is moving away from a higher time frame mitigation. Where is it going to want to move back into, right? A higher time frame, that's a higher time frame unmitigated zone that is above, right? And this is how we see price deliverance. So as Burton said, right, between this point, so, or should I say this point and this point, the market can look however it wants to look. We understand that it's building cause, right? It can look confusing. It could look really messy. It could look very clean. It could look like this, right, where we're not really sure what's happening, right? Or it could look nice and clean, right? And we can all see, you know, we have our equal lows and then price is nice, right? So then when price is coming down and we're running, right, it's, you know, super sexy, it's super clear. Price isn't always going to be like that, but we understand that this middle part of this phase, right, after this initiation is to do what? Is to create cause, right? So what are we focusing on? We're focusing on where ranges are being left and where mitigations are continuing prices, because we know that in the future, these will be aimed for to take, right? So that's how we're watching price move away. Yeah, and Burnt's going to continue from the mitigation.
So once obviously we get a mitigation at a higher time frame point of interest, obviously we're looking for a momentum shift. So here we see that momentum shift, but we never get that A, B, B to C, C to D leg. So this is essentially an unmitigated range now for something in the future, which obviously then becomes a point of interest in the future. But this is what we was talking about as well. So if we do see a momentum shift and we don't get that C leg, but we just see a lot of aggression to the downside, now all we're looking for is that next range, initiation, mitigation, continuation, price delivery, because we know that this is going to be a higher time frame unmitigated range left here for a future point. So instead of just sitting here on our hands waiting for this to come all the way back up to here, now we're looking to get into a continuation position and obviously continue this move, because if we know price is going to see lower prices from a higher time frame point, then this is still in a great price to be selling from, because this is in premium prices. So any sort of continuations in here are going to be nice continuations to take. And also, as was going through previously, when price is creating liquidity on the other side, see how price is creating liquidity on this side as well, as the highs are being stacked on this side, creating more and more and more liquidity for this move up, so that when we do mitigate out of this position on the higher time frame, we have some liquidity to aim for and some unmitigated ranges and OBs that we can potentially aim for. Yes, yep. Unmitigated ranges and things that we can aim for. So again, it will just be the same range, initiation, mitigation, continuation. But once we've had that mitigation at that higher time frame point of interest that's caused a momentum shift, so here we see that momentum shift actually do create that C and then continue higher prices. So when we do see that momentum shift at the higher time frame, sorry, it's not really, let's do that clearer. So when we do see that momentum shift at this higher time frame point of interest now we know that we're initiating higher prices. So then obviously we see range, initiation, mitigation, continuation, and that's how we're now able to follow, again, range, initiation, mitigation, continuation. Follow the money, essentially, follow the demand in the market that's moving, follow the mitigations, and then essentially all of this on this side again creates cause for higher prices. We create more liquidity for higher prices, and again watch how prices create liquidity for lower prices for something in the future. So that's why we say every single move in the market has its reasons. You just need to understand what's actually happening on both sides, so that obviously you can have something to aim for after we get a mitigation on a higher time frame. And that's literally it. We're just trading between 2 points on a higher time frame, using our understanding of what's happening between those 2 points and what liquidity is created and what continuation price deliveries are created, because it's literally exactly the same thing. It's just about training your eyes to see the variations of this between this high and this low, and obviously just understanding where you want to take profits as well if we're between two higher time frame points. But yeah, that was everything.
Because yeah, I was gonna say, you can be, you know, there's two traders in here, right? Quite simply, there's a trader taking shorts, right, and there's a trader taking longs, right? What's the trader taking? What's the trader taking shorts from, right? Well, I understand that if I'm taking shorts from this, I am following that higher time frame mitigation for lower prices, right? And where's it going to want to aim? Well, you know, it's going to want to take out at least that swing low, right? So that's fine. And I'm looking to play price until it gets there. So I'm looking for shorts. Yeah, where can I look for shorts? Well, quite simply here, I could be getting something like this, playing that continuation before that break, right? Playing that continuation, playing that continuation, playing that continuation, playing this continuation, right? So I play this continuation. You see that this one doesn't follow through. Okay, that one doesn't play out, right? Take this one. Okay, maybe that one doesn't play out. You know, that's fine. Look at the cause. Okay, cool. I've missed that. You know, okay, here's one. Get into that one. Bam, right? So short trader, you know, there's several things in here that we can look at to say, right, you know, yeah, I can look for reasons to get short, right? And I can look to take those shorts and look what would happen, right? At least a couple of these trades I could have held or you know, could have been fine. And, you know, most people would have caught those shorts. Then you have the opposite, right? You have the trader that's looking for longs. Where are they looking for longs? Well, they're going to be looking left, right? They're going to be looking to play reactions that have come from something, right? Because why? Because we can determine that this is left unmitigated and it will likely see a reaction. If I take my risk here to hedge, where am I hedging? I'm hedging in a pretty good position, right? But we don't see no follow through, right? Don't see no follow through. I can do this all day here. This one, right? We see that run up, mitigation, right? In that swing leg, right? Move away, right? So again, here I could have been a short profit and then that profit would have been taken from me, right? So when you're taking losses or when you're taking, or when you're having wins, right? Always ask yourself, right? Am I on the right direction? I mean, you want to know, obviously, but this is where we want to start to understand right now, am I trading with, right? What is being left here, right? Or what is being left here. Right, this is where we're able to just determine. And quite easily, if we're seeing this intention, I look for shorts, I play my shorts. If I'm back here and I see this intention for higher prices, I play intentions for higher prices. Right? It's pretty simple. Why? Because we have that footprint, right? Out of mitigation, high time frame mitigation, and the same up here. Why? Because we have that footprint out of a higher time frame mitigation. And now all I'm doing is playing that intention for lower prices. And as you see, time and time again, it works out, right? If you want to go into a lower time and look for the same thing, right, you're gonna see it, right? The only difference here is that the pippage is gonna be shorter distance, right? So instead of seeing a 20-30 pip move, you might only see a 7 to 8 pip move, right? But the market is consistently moving like this. And then if we pull the chart right, we see now that all them reaction points that Burton drew on, right? We can see how price is using, right? See all of this liquidity built here. Yeah, exactly. Right, range reaction, creates higher prices, right? Where does it move above, right? Well, what's this on a higher time frame? Right? We're seeing sideways price delivery, right? Notice that price reacts, right? And then price flies. Look, why is price moving like this? Look at the aggression. It's because of this, what's left and what's been left here, right? And what's been left above, more importantly. That's going to create this just to act as liquidity. Like I said, if you're taking this trade, right, ask yourself where you're taking this trade. You're taking this trade at 50% of the range. What do we say about trades in the middle of the range? Simple. So do you take this loss or do you not take the loss? Right. This is just a level of skill that you have as a trader. Because me, I would say, okay, I'm probably stay away from this trade because it's in the middle, where someone else might say, oh no, look, we're about to react. I'm gonna put an order on for that reaction. Nothing happens to get taken out. Right, that's great. You've played a reaction point. That's fine. Where's the next reaction point? Right. We see obviously this one reacts up here. This looks like, I mean, I can't really see because there's so much on my screen, but let's say it's this range in here. That's where we see a reaction. Again, we can see we've got no intentions for lower prices. We hold, and what happens once again, right? We get that range initiation out of the range, and where does price come back into? Right? Straight back into a range. Right? Notice as well, when we're looking at things that happen on the left, we also want to understand how things, right, and how things on the right are respecting that. Because what you will see time and time again, right, is the same thing. It looks different because we're looking at price move up and move down, but actually this is the same picture. Cause is being built on both sides, and intention has been shown. So you play your longs, you play your shorts, we have no bias. And when price gets run, we understand that now intentions for the next phase can happen. Whether we see a run of lower prices or we see a run and a pullback, right? Then we understand what all these ranges then become, right? And then what do we see that we're drawing? We're just drawing contained price action. What does this mean? Well, on a higher time frame, we know what this means, right? They're stacking price between the range. So see how it's the same thing. We're repeating the same things over and over and over and over. And it's because we're witnessing the same thing happen. It's just you can't recognize, you may not be able to recognize it right now, right? But that representation of price delivery is what we see. Remember, this is how BFIs, and the only way, well, that we know of at the moment, the only way BFIs can initiate their orders and manipulate the market, because their orders are so big. Right, they can't disguise them. They can't disguise them or hide them. They do their best, but once they initiate prices, right, we know what direction they're intending. So this is where we follow along, right? So this is all this information is coming back in to the same bits of information that you guys already know, right? Because we can talk about weak highs, strong highs. We can talk about cores. We can talk about OBs, right? We can talk about all of these different things, right? But they're all relating to the same ideal price delivery. Yes.
And literally that's it. And that's literally how we trade as well. It's just understanding where we are on the higher time frame, what the direction is in terms of that price delivery or that price delivery, what direction are we trading in, and we're just dropping to the M1 and just trading between those ranges. Essentially that's what we're doing. We're just understanding also the whole picture on the lower time frame. We're understanding how course is built on the lower time frame, how course is taken, how positions are initiated, and then again we're just going from range to range on the lower time frame. So if we have intentions at higher prices, we're just following bullish price delivery, watching range to range, and this is literally just following the money, following the mitigations all the way up until new ranges are created, mitigation, continuation, essentially a whole new range, initiation, mitigation, continuation. We're just following higher prices. That's essentially all we're doing, and we're just watching as liquidity is built and confirmed. But that's literally it. That's how we're trading. That's how we're building narratives. That's how we're understanding the delivery of price. That's how we understand liquidity and the whole price delivery in general, and how essentially we'll come up with weak highs and strong highs and so on and so on, and how we interpreted all these concepts, because it's all an interpretation from price delivery. So when we understood price delivery and how to read that on multiple time frames, then we were able to just drop this into the lower time frames and just learn everything basically, and that's literally what we've done.
And just witnessing and believing it unfold in front of us, right? We never held no expectations. I wasn't trying to talk as if I should know, I should be correct, I must be correct, right? All I was trying to do is just understand how, all we was trying to understand, is how is price being delivered, right? All these educators, they're all given information. It's about using that information to build an interpretation of what you're seeing. And this is what we're showing you. This is our interpretation of price delivery, but don't listen to us and what we believe. Take the information into the markets and train your eyes, right? You don't have to be 100% correct and accurate straight away, right? It's about building that skill and building the recognition, right? Because over time you will start to see it, you'll start to believe it, you start to grow your confidence, then you start to look at executions from your marking up in hindsight, and then all of a sudden you have an ideal recipe on how to get into these markets. Not my recipe, not Burton's recipe, not Toby's recipe, right? Not Fuad's recipe, right? We're getting the rest, you're creating your own. And this is where we talk about it's all the traders are individual, and we have, we take a lot of pride in that, right? Take a lot of pride in that. So allow yourselves to feel good that you're building your own way, but using the same information, right, as everyone else. And this is what, again, keeps us all in the same page. We can all have different views, but we understand each other's charts because we're all reading the market from this, lens that's repeatable. And this is how we can, essentially how we can stay consistent with the market all the time.
Exactly. So also thank you for watching the video, guys. Let us know any takeaways from today's video as well. And yeah, get stuck into price delivery.
Yeah, like take the hot, just relax a bit, right? Yes, we all want to trade, we want to place trades. Yes, we all want to be accurate, down to 2 pips. But remember, it will come with time. That's a fact, right? First of all, we just want to train our eyes and we want to get comfortable with what we're seeing, right? As soon as you start to rush into it and start to place trades, this is where you're essentially slowing your progression for some. Not all. For some, of course, some will, benefit more from that. But use this video and to take away the focus on price delivery, right? Don't get lost on lower time frames, right? Use your time frames to allow yourself to understand what's happening, right? If you have a belief or an understanding or expectation that we're going to see higher prices, let it go. Keep the idea and wait for it to play out, because then you can take that lesson away. If you're trying to hold on to something before it's happened, you're predicting price and now you're waiting for your expectations to be met, and that is going to create emotional decisions or thinking, right? And this is what we want to try and make sure we not eradicate, but we minimize and manage. Right, so take this and implement it into the week. And again, how strong we feel about observation. This is where the skill is built, right? So get stuck in. So appreciate your time, and have a fantastic week, everyone.
Yeah, thank you, guys.